Hello, everybody, and welcome back to another series of Decoding Pro Investors. Here, we'll be talking about one of the most learned pro professors who had introduced the concept of value investing into the world of financial markets. And interestingly, he is also the mentor or tutor of Mr. Warren Buffett, who has been the epitome of value investing. This person who we are going to decode is someone who might not be very well known to the non-investing public, but among the investing people, he is one of the most reputed person who started the trend of value investing. He is none other than Mr. Benjamin Graham. So Benjamin Graham is known as the father of value investing. So Mr. Benjamin Graham, in his books Intelligent Investor and Security Analysis, has laid out several principles that outlines the entire concept of value investing. But it is important to note that unlike Mr. Warren Buffett or Peter Lynch, Graham sir does not have a qualitative screener or filter for his stock picking. Rather, he relies on quantitative data and is ready to find value wherever it is found. And he's not in selective like the management should be like this, like that, and so on. So we will have a look at the qualitative screening in a short while. So let's get to it. So here we are, and this is the quantitative framework that Mr. Graham uses to pick the companies. So first and foremost, it'll be the earnings to price ratio. So earnings to price is basically your inverse of price earnings multiple. We have all known price earnings multiple for quite a lot, and we also have been familiarized with the concept of the lower the multiple, the cheaper it is. But on the converse side, if we invert it, it becomes your earnings yield that Mr. Warren Buffett infamously uses. And earnings yield is nothing but how much return the company gives for your share price when you purchase it at this point in time. So at an EPS of 10, if the company has a share price of 100, then it would most likely have a earnings yield of 10%. So 10 by 100. So EPS divided by your current price. So, and that should be more than or equal to two times your AAA corporate bond yield. So AAA is the safest in the corporate bond space. We know all these ratings: AAA, AA, A plus, AA minus, and all those stuff. It goes down from the top, and it is given by S&P, CARE, ICRA, and I think there's one more India ratings in India. So, with that being said, earnings to price has to be more than two times your AAA bond yield. The PE has to be less than a five-year average. The dividend yield should be more than two-thirds your corporate bond yield. So, if your corporate bond is yielding about 10%, then the stock that we're going to pick should have a dividend yield of more than 6.7%. Okay, and the price should be less than two-thirds of the tangible book value. Now, tangible book value is nothing but your current assets. I mean, the total assets, the book value of equity, which is the total assets minus external liabilities, minus your intangible assets as well. So that becomes your tangible book value. And then price is less than two-thirds of net current asset value. Net current asset value is your current assets minus current liabilities, which is infamously called the working capital. And the working cap, it should be like two-thirds of the working capital. Then debt equity should be less than one. Current assets should be two times the current liabilities. Debt should be less than two times the current assets. So basically, if you liquidate your current assets, you should repay half your debt. That is what is basically the implication. Historical EPS growth should be more than 7% over the last 5-10 years. That is basically a measure of shareholder wealth. And there should be not more than 2 years of consecutive declining earnings. That is a very crucial factor for Graham. So Mr. Graham has a quantitative filter, as we spoke earlier, and here we are at the valuation part. Now, how do you value a company? So there's a framework that Mr. Graham has given out for valuing a company. Oh my God, my bad. Okay, which is equal, the value of a company is your EPS times two times your forward growth rate. Okay, expected growth rate in the future, and 8.5 is your price earnings multiple. So this is a reasonable multiple for a company with no growth. In times your treasury bond rate, the yield on your treasury bonds divided by your yield on AAA bond. So there's a distinction between a treasury bond and a corporate AAA bond. So treasury bond is basically your risk-free bond issued by your government, the government of India, the RBI, or the US government. We have come through this news that US government has mounting amount of debt, right? That is basically through US Treasury bonds and primarily. So that is your yield. Now we will go inch by inch and set up a filter by on screen. Now we'll find out what companies fit this criteria by individually examining what the yields are, what can be the what are the yields in the corporate space, what are the yields in the treasury space, and we will put all these filters into action. Okay, so without wasting any more time, let's get to the filters part. Hello, everybody. Let's get to the stock screening process now. But before we get into this, we would need the yields, right? For the corporate bond and the treasury bond. So I'm going to Perplexity. Okay, that is hands down one of the best deep research tools. I've already searched for this, and it is about 7% average for the corporate bonds and 6.5% for government bonds, right? And I've also mentioned them on here. So without wasting time, let's get to the screening process. So earnings to price has to be more than two times your corporate bond yield. Now for that, so 7% into 2 is 14. I need a 14 earnings to price. Okay, if I invert, that gives me the price to earnings of 7.14 times, right? So I need a price to earnings of sorry, less than 7 times, and it should be less than your historical PE of 5 years, right? Then we have price to be the dividend yield to be more than two-thirds your AAA corporate bond, so which is 7 times. So more than two-thirds comes to about 4 times. So I'll put 4, and then you want your price to book, okay, to be less than what two-thirds your tangible book value. So that should be around 0.67, right? Two-thirds is 0.67. And then we have a lower debt equity. Okay, we will filter this when we go into individual companies. So debt equity of less than 1, current ratio of 2 times, debt to equity should be less than 1, and whoops, current ratio to be greater than 2, and what else, debt to be less than 2 times current assets, right? Debt levels should be less than 2 times current assets, right? And we have historical EPS growth of 7% and no more than 2 years. Okay, that has to be historical EPS. Okay, that's not there. EPS growth, yeah. Let's take 5 years to be greater than 7%. Okay, so this is our basic filter. After this, we go into a company and do its valuation, right? We run this query. Okay, do we get any company? Zero results found. So, guys, Graham is a very keen value investor, right? So, we will not be able to use this filter, and he belongs to the early 19th era. So, he was around 1950, 1960, if I'm not wrong, 1970s, around that range. So, back then, the companies were available at dirt cheap valuations, but now they don't, right? And especially in a growing market like India, it always commands a premium. Okay, so for the purpose of this video, I'm going to consider the example of HDFC Bank purely on the basis of valuation. Nothing more, nothing less, just valuing the company. So what did we say was the valuation framework? It was EPS times 2 times growth plus 8.5 the multiple, they're multiplied by your treasury bond rate by the corporate bond rate, right? So here we go to the profit and loss. Okay, we will assume 20%, which has been the historical growth rate, to be a growth rate 1 year down the line. Okay, so 20% is your growth rate, 8.5 is your multiple. Let us put that into the calculator. Okay, 2 into 0.2, which is your growth rate, 0.4 plus 8.5 times, okay, multiplied by 46.26, which was the FY25 EPS. This one, 46.26. Okay, multiplied by 6.5% of your corporate bond yield divided by 7%, 6.5 of treasury bond yield divided by 7% of your corporate bond yield. So that arrives at 382.3, which is the intrinsic value of HDFC Bank as per the Grahamian approach. So, Graham's approach certainly does not work in Indian markets. Why? Because it trades at a premium, and India is a developing markets as against the US, which is a developed market. And number three is that the times have changed. This is a dynamic business environment, and no business trades at dirt cheap valuations as given by Graham's criteria. So, with that, we conclude this video, and I hope you like this. If you do, please do like, give a subscribe, and stay tuned for more such videos. The next video will also be on a very big fund manager in India. So I'm not going very big, but I will stick to Indian fund managers and the legends of the Indian markets. So stay tuned for that, and I'll see you in the next video.